Hi there, Sunday, August 5th, 2007. The weekend after the market was down 281 points on Friday. People are getting nervous on Wall Street. I've got some CNBC online, some Bloomberg, Barron's, Wall Street Journal, Investors Business Daily. Made a trip down to Barnes & Noble. So I'm going to dive into it. Things are happening fast. Bear Stearns. Frankly, I wish I would have had more put options. I could have made 10, 15, 20 times my money in the last 3 weeks, but didn't have it. So spectacular things are going on and to the downside. But let's start with Barron's. Okay? Financial publication. For you Wall Street people, you might know about Barron's. For you that don't, I'm going to read you some interesting things from Barron's. Great commentator in there for years named Alan Abelson, and he goes into and talks about last week's action and Friday's action. And so he's always humorous and witty. And I'm going to read part of Alan Abelson's column, okay? Help you get a grasp. You know what? If you're not a super finance person, I love this stuff, but just try to bear with me and take some of it in because it's very important. The melancholy truth is that, far from subsiding or even being content demolishing the subprime market, the dark woes that have been savaging mortgage credit are proving highly infectious. As ISI Group's Tom Gallagher and Andy Lapierre, who've been spot on, first about the gathering crisis and then the collapse of the subprime loans, noted last Friday, quote, "There has been a sea change," end quote, in just the past few days, and most definitely not for the better in the availability of credit. And I'm going to talk about that some more, the availability of credit. Last year, they point out grimly, subprime and Alt-A, which are a notch or so up from subprime in loan quality, each accounted for roughly 20% of the home mortgage market. And today, both are conspicuously under the gun. What this foreshadows is a much tighter supply of housing credit and, as night follows day, a big drop in the demand for houses. Okay? A big drop in the demand for houses. All things being equal, there'll be less money, less people that can qualify for loans, and so this downward trend in home prices will accelerate from this one thing. And if 20% of loans are all of a sudden taken out of the market, that means for every 10 buyers you now have 8. For all things being equal to if you went back just a year ago. That's a big deal. Just think if you're trying to sell your house and all of a sudden 2 buyers are just taken out. Well, as more and more buyers are taken out because they can't qualify for the loans or they lose their job or whatever, you're going to have fewer and fewer people willing to buy the massive amount of houses that are on the market. Let's get back to Alan Abelson. And warn Tom and Andy, unless there's a significant reversal and fast, the credit crunch in the mortgage market will be worse than the most pessimistic assumptions. And that would be strictly bad news, not only for the early visible casualties like the mortgage finance outfits, investment banks, and other mortgage companies and their stocks, but for the economy as a whole. The whole economy. Are you listening, Mr. Paulson? The stock market is. That's a little aside to the Treasury of the Secretary here in the United States. Stocks finally had their bounce last week, only to run into a buzzsaw in the final session. Early on Friday, Goldilocks took a spill when the Bureau of Labor, or is it Labored Statistics, released July's job report. And it sure wasn't anything to write home about. A much more modest gain in hiring than the street seers anticipated, coupled with a rise in the unemployment rate, gave the briefly revived bulls that sinking feeling once again. And as the day wore on, those extremely bad vibes from housing and battered mortgage market and furrowed brows of lenders of every description began to make everyone who hadn't escaped to the Hamptons very, very nervous. And then that awful cracking sound you may have heard was the bond market buckling and finally breaking wide open, which didn't exactly do much to shore up sentiment. And just what badly bruised bonds didn't need was for the chief financial officer of Bear Stearns, and who would know better? It's funny, but it's brutal too, to tell analysts in a conference call that things in the fixed income market were, quote, as bad as I've seen it in 22 years. And to compare the current environment with the debt crisis of the late 1990s. Maybe the Thais and the Russians and the rest of those developing countries who were in the soup back then will remember who bailed them out and buy some of our wobbly bonds. Do us a favor, though, and don't hold your breath while waiting. Although we didn't have time to ask him, we have a hunch none of this came as a shock to Jeremy Grantham, who runs GMO, which manages very big bucks for institutions and affluent individuals. For in his latest quarterly letter dated July, Jeremy pretty much advised investors to expect the worst. He pointed out that the mushrooming growth of leveraged loans, some $545 billion globally in the first half and up a notable 60% over the corresponding '06 total, was very much reminiscent of the equivalent gain in price of the internet and tech stocks in the opening 6 months of 1999. He suggested too that there's an uncomfortably close affinity between all the fuss and media attention paid to the online and tech heroes then and the current hoopla over the new LBO masters of the universe. More than likely, he implied, this new Gilded Age will end as ignominiously as did its predecessor 6 years ago. Jeremy confided that he had been trying to come up with a straightforward formula to capture, quote, how serious the situation is for the overstretched, over-leveraged financial system, end quote. The simple statement he hit on was that in 5 years he expected that at least one major bank will go belly up, and that as many as half of the hedge funds and substantial percentage of the private equity funds now throwing their money and weight around will have ceased to exist. Jeremy's words on that part. Jeremy, who has seen it all in his 40 years in the investing business, freely acknowledged he has, quote, often been too bearish about the U.S. equity markets in the last 12 years, end quote. Although to his credit and his client's satisfaction, he has been a big bull on emerging equity markets. But, he asserted, quote, I think it is fair to say that my language has almost never been this dire. The feeling I have today is that of watching a very slow-moving train wreck, end quote from Jeremy. And then Abelson sticks this in. That train wreck has picked up speed since Jeremy wrote these words, and we suspect the nightmarish ride is far from over. You know, Barron's great publication. Thanks, Alan Abelson. Investor Business Daily. Great paper, a lot of information. Credit woes grow as fear over fears worsen problems. Back when home lenders were handing out mortgages like lollipops and banks were making sweet financing deals for leveraged buyouts, nobody talked too much about irrational exuberance. Now that the pendulum has swung the other way and credit standards are tightening, nobody's talking too much about irrational anxiety either. But some experts say it might be a useful conversation, if for no other reason than to lend balance to the cacophony of moans over ailing subprime mortgage and credit markets. The moans seem to be growing louder daily. On Friday, mortgage lender American Home Mortgage closed most of its operations and said it is likely will file for bankruptcy. Earlier in the week, accredited home lenders sent out signals that it might be in danger of going under too. That's IBD. Let's talk some more about mortgages and how this works out. A good article from CNBC. Mortgage prime for trouble. Crunch and squeeze. This is August 3rd from CNBC. Jim Kingsland. Here's another reason to worry about the housing market. It's getting harder and more expensive to get a mortgage. Because of a growing credit crunch, lenders are tightening standards and raising mortgage rates for people with average or below average credit ratings. Even homeowners with good credit scores are seeing their higher rates on so-called jumbo loans. Those that range from roughly $400,000 to $600,000, depending on which part of the country you live in. Banks want to see higher credit scores and more money in the bank and larger down payments, said Melissa Cohn, chief executive of Manhattan Mortgage and New York Mortgage Broker. Okay, it's pretty self-evident what this means. Less people are going to qualify for mortgages. Once again, less people can buy homes.